So yesterday I shared a list. This is from The Economist, ranking the top titans of American history. Now, most of the names are actually from the Second Industrial Revolution. Many call them robber barons, yet their collective efforts lifted the United States above the rest of the world. I mean, in a 50-year period, it was remarkable. Also sparked shared prosperity for the first time in human history. The other thing they all have in common is that they faced unrelenting criticism while building their economic empires. Fast forward to current Fourth Industrial Revolution, and well, we've got what I call the golden age of visionaries and achievers. Not only did the establishment, for instance, mock Elon Musk, but it also lost billions of dollars betting against him in 2020. And that was the year the current retail investor revolution unfolded. That's when it blossomed, right? And they embraced folks like Musk, but they also bought stocks that the establishment had written off. I personally fell in love with them immediately with this crowd because that's how I began my own investing journey. After I saved $1,000 in my first full year in the U.S. Air Force, I went down to the Dean Witter office in Minot, North Dakota, and I bought shares of MCI. And the reason was simple. I fell in love with stories of William McGowan. This guy was a chain-smoking, coffee-guzzling workaholic. He was taking on the biggest company in the world with a ragtag business model, AT&T. He passed in 1992, and his funeral card said it best: "The meek shall inherit the world, but they'll never increase market share." This is the golden age of visionaries, folks, but also of experts who never built anything. I mean, critics, curmudgeons, all those folks, of course, who bet against the spirit of individualism. And it reminds me of the Ellsworth Toohey character in the movie and the book Fountainhead.
You'll never hire an architect who is a genius. I don't like geniuses. They're dangerous.
How's that?
A man abler than his brothers insults them by implication. He must not aspire to any virtue which cannot be shared.
Oh, I wouldn't know about that intellectual stuff. I play the stock market.
I play the stock market of the spirit. And I sell short.
Now, according to a character study, by making people feel small and guilty, Toohey shapes their faith in their own abilities, right? And their own ability to control their own lives. I want to bring in now GameStop Chairman and CEO Ryan Cohen. And Ryan, first and foremost, I want to say thanks for coming on. You made headlines in more ways than one yesterday. So I tell you what, let's just begin with the announcement. The announcement, your intention to purchase eBay, $125 a share, $56 billion. We know the deal's half cash and half stock. The stock part is pretty simple to understand, right? The higher the price goes, the fewer shares you have to put out there. But the information put out a piece that actually applauded your chutzpah. And they said, though, that the deal was doomed because the cash isn't properly financed. Now, I understand if there are elements of the cash part, including potential outside investors, you may not want to mention, but can you give us more details, as comfortable as you are with the details on the cash part of this?
Yeah, we have, well, good to see you, by the way, Charles.
You too.
It's a pleasure. We have a $20 billion highly committed letter from TD that we, as well as the bank, feels very confident they can place. And we've got $9 billion of cash on our balance sheet. And in simplistic terms, the structure of the deal is very simple. So it's $125 a share. 50% is paid out in cash, which is $28 billion. And the other 50% is equity that's being rolled into eBay and GameStop. So people don't understand how it's possible to do a transaction like this. So in easy terms, say business A is eBay. It's making $40,000. Just use round numbers for argument's sake. And business B is GameStop. If this was a stock for stock deal, we were combining both businesses, GME shareholders would own 80%. GME shareholders would own 20%. eBay would own 80%. But what we're proposing is immediate liquidity to eBay shareholders. So instead of them owning 80%, they'd be owning 60%. So they're owning 60% of 50,000 in earnings, and GameStop shareholders are owning 40% of 50,000 in earnings. Now, I'm confident that I can increase the value of eBay and their earnings by cutting costs dramatically. They're spending $2.5 billion in sales and marketing, and we can make that much more efficient. So it's going to go from business A of making 40,000, it's going to be making 80,000. So now the combined business is making 90,000. And there's different kinds of dilution. There's dilution that decreases earnings per share, and there's dilution that is accretive to earnings per share. This is a transaction that I believe is accretive to both eBay shareholders and GameStop shareholders, because we're going to increase earnings per share significantly by making the business more efficient, and GameStop is going to continue to be more profitable too. So the combined business can be making more than $90,000. And when you look at eBay's business as an example, you look at their operating expenses of over $5.6 billion on an $11 billion business. It's a business that can be run much more efficiently. There's no inventory. It's an asset-light business. It can be run much more efficiently, with an owner's mentality. And that's putting aside any kind of growth. That's just from treating it like a family business and operating more efficiently.
Yeah, to that point, the question's been asked, why would eBay shareholders want a deal like this? And I think about the current management situation. They paid themselves over the last few years, gobs, millions and millions of dollars. They never buy back their own stock. They've done nothing really innovative at all with respect to that. And here, I think, really, for me, my opinion is, you're the linchpin. You're the key to this, right? And it's not unlike the New York Giants saying, "Hey, we're going to trade for a better quarterback." And I don't know why traditional Wall Street doesn't get that, particularly when they fawn over deals like Paramount, an $11 billion company, making a $100 billion deal. They can see that, but they can't somehow see you orchestrating this deal, and I think it's frustrating.
We'll see what happens. It's good. There always needs to be a healthy dose of skepticism.
Yeah. Speaking of which, this morning, Vlad was on CNBC, and they tried to get him to talk badly about these investors, folks who are on social media who support you, people who own your stock. I mean, what do you say to these people, folks who are just right now watching this interview that have put their hard-earned money behind Ryan Cohen, saying he's going to make this work, despite what the fact what the establishment media, the financial media says about you and this deal?
I mean, the way you opened up the show is exactly what the situation is. I mean, there's a lot of experts. They've never run a business. If you look at GameStop and where it is today and where the experts predicted GameStop was going to be, it's doing a little bit different. And I'd rather not say, just look at our financial results, right, and you can play all the old clips of, from all the experts and the Wall Street, the Wall Street analysts that were bearish on the company. And frankly, by the way, the company should have been bankrupt many times over. It is a very, very tough business, but it's making healthy profits now. So they weren't wrong. If the old management would have continued running the company, then we wouldn't be having this conversation now. At least it wouldn't be about GameStop, right, if they would have continued running the show.
Right. There's no doubt about that. Let me, again, picking up on that though, because you've been pretty tough, and you wrote this great piece called "The Hollow Men." Before we get into that though, Semaphore put out a piece. They said about Ryan Cohen, the billionaire didn't help his case Monday when he squandered what goodwill he had with the street in a disastrous CNBC interview, playing to his base rather than in the investors he now needs. By showing contempt for legacy financial press and big institutional investors, those investors are crucial if he is serious about taking over eBay. Your thoughts?
Can't take it too seriously. It's okay.
Okay. Let me pick up though on the hollow man post, because you did suggest American capitalism is rotting from the head down. Let's talk about that, because I tend to agree with you. This period that we're in, we have people who are doing amazing things, and folks who have no concept or understanding of what they're doing or their vision get to beat them up all day and night. But what are the consequences if we just, if we don't find a way to sort of re-embrace entrepreneurship and risk-taking the way you and others have?
A good example is this situation. You look at our board fees. Nobody really talks about this. Our board fees are zero, and the majority of our board has invested their own personal capital into this company, and in many cases, a substantial amount of their personal capital. And you look at most boards in America, and you look at eBay's board as a good example. Their board fees are like $4 million a year. I think their average director is getting paid $350,000 a year, 6 times the GDP of America to show up at a few board meetings. There's a problem with that in terms of like the system. It just should not be like that. And if you look at insider buying at the company over the past 5 years, it's like our board fees. It's zero insider bought.
Right.
If you look at insider selling, it's hundreds of millions of dollars. So the system, there's a deep problem with the system that exists, but that's corporate America.
Well, Ryan, I want to say thank you for coming on. I'm wishing you luck. I'm still a shareholder, and I still have faith. So thank you very much, and hopefully you'll come back soon. We can pick up on this conversation.
It's great to see you, Charles.
You too. Thanks a lot.
Bye.
All right, folks. Coming up,